Welcome to Hunting the Great Red Capital Gains Shark. This podcast is being sponsored by CB Administrative Services. CB Administrative Services is a third-party trustee that specializes in all the different ways to defer, reduce, or even eliminate capital gains tax. We put together these podcasts for business owners, property owners, folks that own digital currency, and even other professionals. This particular podcast is all about the very basics of capital gains itself. What is capital gains tax? Roughly, how do you compute it? And then what are your choices with how you treat it? There are two very important things with capital gains that I'd like you to understand. First of all, capital gains tax is actually a discount over your ordinary income tax rate. It's potentially even 0%. So capital gains is a good thing. Capital gains is based on an asset of which there can be multiple types of categories of assets. The IRS will define them through Topic 409 and further define them if they're inherited or part of a trust. But for our purposes, we're just going to say that an asset is any sort of personal property, collectible, art piece, tangible real property, business use assets, vehicles, luxury items, digital currency, things of the like. Anything that's an asset that has growth is potentially subject to capital gains rates. And one little caveat, if you have a capital asset and it's actually sold at a loss, well, then perhaps that's one way to treat your capital gains just by simply performing a wash transaction. More on that in a second. So here in the United States, there's only 3 different tools that you have. When you buy something, you can either purchase it after tax or before tax. When you grow the value of the asset, you can either have it in a taxable structure or something that is tax advantaged. And when you actually receive, collect, or spend that money, you can either do it taxably or tax-free. So of course, what everybody wants to do is to buy something before tax, grow it tax advantaged, and then spend it tax-free. Well, you can't do that. You can only do 2 of the 3. And each time that you perform a tax advantage transaction, keep in mind that there are going to be a couple of restrictions. When you actually pay your tax, what you buy is full and free use of the asset after sale. So a little bit more on an asset. An asset is anything that you own that appreciates or devalues over time. If you own that asset for more than 12 months, you're subject to long-term capital gains rates. Remember, that's the discount. Any asset that's held under 12 months is still going to be taxed at ordinary income. And keep in mind, the state that you live in, if it has an income tax, is not going to offer a discount for assets. Generally speaking, if your state charges income tax, anything that you pay the federal government for in terms of long-term capital gains is going to be considered ordinary income at the state level. So just keep that in mind. And this is a quick rundown of exactly how to hunt the great red capital gains shark. You have 2 main tools. Your first main tool is how much income you declare. If you declare income under $60,000 in the year of a sale, well, then technically the proportionate amount of that would be subject to long-term capital gains will be paying capital gains at a 0% rate, which is great. That's exactly what you want. If you have income between $60,000 and roughly $496,000, then your long-term capital gains rate at the federal side will be around 15%. And if your combined income from all sources exceeds $496,000, your long-term capital gains rate will be 20%, plus whatever your state may charge. So income, how to declare income, is your main tool. That leads you to a bunch of different installment techniques and different sorts of offsets. Now, if you offset say you have an asset that you purchased that is now worth less than what you paid for it. Well, that is a capital loss, and that can be used to offset capital gains to a certain amount. Check with your tax advisor. Those are your two main tools. Other than that, you have to do some fancy footwork to reduce, eliminate, or defer that gains tax until you have a choice about when to spend the money in the most advantageous way possible. And as a caveat, if you have digital currency, it's probably not at a 20% long-term capital gains rate. Current interpretation is that you may be subject to a 28% federal taxable rate. So owners of digital currency have extra homework ahead of them. These are the IRS publications and topics that will help you determine if you have a capital asset and what adjustments to basis may be allowed, and whether or not that asset is purchased or inherited. Different caveats for each. Thank you very much for stopping in, and be sure to tune in for more from the Great Red Capital Gains Shark as we delve further into this tricksome deal of addressing capital gains in the most favorable ways possible.